Ladies and gentlemen, as expected, the stock market hit a new all-time high today. And here in this video, I will share with you all of your economic data, all of your news that you need to know, what is driving markets higher at this point. But I will tell you, yeah, there's a lot of economic data. There's some weird things going on. Forget all of it, okay? Markets are now at new all-time highs. Bearish investors are forced to capitulate. They're forced to get reallocated to markets, and it shows the longevity of this rally. This was not just a bear market rally and we failed before new all-time highs. Nope, we hit new all-time highs today. Now, typically what tends to happen is once you hit a new all-time high, people start to chase. Okay, people start to allocate. They start to cover on short positions. Why? Because when you hit a new all-time high, you tend to continue to hit more new all-time highs. It doesn't tend to be a one and done kind of thing. It tends to be a high preceded by a new high that's preceded by a new high. And we're just hitting that new all-time high. So where does this rally go from here? Well, obviously it depends on earnings. We have a new earnings season starting up here pretty soon. We're going to be getting more economic data, but I think we're all focusing on 2026 and what the landscape is going to look like. I think we're going to have a situation where we don't have inflation. We have a much more dovish new Fed chair coming in. We're going to get a bunch of rate cuts. AI is on fire. The economy is doing okay. Not great, not bad, but just okay. And that likely gives markets room to continue higher from here. That's why I'm leaning into this market. I'm not running from this market and running from these new all-time highs. That is never a good strategy to, sell out as the markets hit new all-time highs after previously falling 20-ish%. Like, normally you want to lean into that and give the markets the benefit of the doubt because they tend to go higher after hitting a new all-time high. So we're going to get into all of this information. I do have some clips from CNBC I want to share with you as well. Hit that like button and subscribe to the channel if you have not done so already. First things first, let's get into it. Now, in your economic data today, durable goods orders month over month surged, okay? This is a great sign, up 16.4%. The estimate was up 8.5%, so it was double versus the estimate. And last month was revised a little bit more negative, from negative 6.3% down to negative 6.6%. But still overall, that's a strong number. Now get this though, Q1 GDP growth rate was expected at negative 0.2%. This is the final number. So this is the last number we will get for Q1 GDP. The final number came in at negative 0.5%. So much worse than expected. And I'm actually surprised that markets today are actually hitting a new all-time high on that bad number. Now, again, durable goods orders came in good. So, there's offsetting things here, but that Q1 GDP number is nasty. Initial jobless claims came in at 236,000, down from the estimated 245,000 and down from last week's 246,000 number. So that's also great news. The goods trades balance came in at negative 96.59 billion. The estimate was negative 88.5 billion. Perhaps maybe that's a little bit better for this current quarter. GDP numbers that we are currently in. Chicago Fed National Activity Index came in negative 0.28%. The estimate was negative 0.1%. You did get a speech from Fed Hammock today. Pending home sales came in actually pretty good for May, up 1.8%. The estimated negative 0.3% was easily beat. And pending home sales year over year for May came in at positive 1.1%. The estimate was negative 2.1%, so that was good. Kansas Fed Composite Index came in at negative 2. The estimate was negative 4, so that was a beat. And Manufacturing Index for the Kansas Fed came in at 5. The estimate was negative 5, so that also beat estimates as well. Ed Barkin says, hiking rates does not seem like the topic of the day amid the cooling inflation trend. That's crazy. That's crazy talk. Fed Barkin says, I worry about taking too much signal from the University of Michigan's sentiment data. And Fed Barkin says, I question how successful businesses will be in trying to pass through tariff increases because, I mean, you could raise prices. You could do what you want with your company. But if people stop buying your product or you sell less of your product, hiking prices is probably not the right move. Fed Barkin says that policy may not be that restrictive. Consumption is steady. Again, incompetent Fed here. Like, do you not see the home market, housing market? Like, yeah, it's clearly restrictive. I think the bigger thing that we should really be questioning is how is inflation data calculated? Because is that flawed? I would say that's probably flawed. We are very restrictive right now. Not maybe like to suggest maybe we're not that restrictive is crazy. Maybe just the inflation data is flawed. So it looks like we have more inflation than we actually have. And thus we're not as restrictive. But we are very restrictive right now. It is really a miracle this economy is not deep in a recession. It really just shows you how strong the US economy is because there's no inflation out here. Like, there's none. Prices are high. They've been high for years, but they're not going up anymore. You're seeing a lot more discounting recently. I have. And it's just shocking to hear the Fed say some of these things. I cannot wait to get a new Fed chair that has a little bit of, common sense. Now, here today in After Hours, you are going to have earnings from Nike. This one's going to be important because Nike did raise prices because of tariffs on certain things. How is demand looking in the face of them actually raising prices? Okay. How is that helping to preserve margins? And what is Nike doing about tariffs? Nike is probably one of the most heavily tariffed companies in the world. If the pause had not happened. So what's Nike's plan here? What's Nike's guidance here? If Nike can manage to get through some of the tariff, problems, then other companies likely will as well. So if Nike has good earnings, has positive things to say, then that's going to be a really good sign for the rest of this market. Now, I do want to share with you a couple of clips from CNBC. This one is from Ryan Dietrich. He says, July is the best month for stocks in a post-election year.
Good to see you. What's your word of the day? We got to jump into this thing, Ryan. It's always good to see you.
Good morning, Frank. Thanks for having me back. I thought it's almost July, so we're going to go with fireworks because, listen, people are going to hear a lot about this. The month of July, Frank, has been higher the last 10 years in a row for the S&P 500. It's the top month the last 20 years, and it's the best month in a post-election year. Now, one more for the listeners. When you're higher in May and June, like we're probably going to be with June because we're up pretty good, July does better, and the final 6 months of the year have been higher 15 the last 16 times. When these weak months are strong, like we're doing right now, that could be a signal this bull market's alive and well.
All right, could be a signal. By the way, we're going to go over this data real quick. Over the past 10 years, in July, the S&P is up about 3.33%. So it's a pretty significant upside move. I want to ask you, what do you see moving us higher? So tech's at a record. Do you see that continuing to break records? And then also we have consumer discretionary, the laggard. Do you see a reversal there? Where do you see the upside moves coming to push us to newer and newer highs in July with a potential 3% upside move if you look at historical precedent?
Yeah, those cyclical areas, we've liked them for a while. Come on with you saying that. Your financials, your industrials, technology, those are the areas that you want to see leading. And what's lagging? It's the defensive stuff, right? So that's a positive market. It's like signals and clues. Those are things you want to see leading in a healthy bull market. We think those areas got us through the dance. They're going to keep leading us in this surprise summer rally.
All right. So, people always look for picks in this spot, Ryan. I know you don't pick stocks, but in general, if you're looking for opportunities to ride this July rally, what would it be?
Momentum stocks. We like those momentum stocks. There's momentum ETFs out there. Those are some of those areas I just talked about in healthy markets is what you see. And again, one more thing on this, Frank. I don't see a lot of optimism. I get to travel the country, talk to people. People are like, I'm still kind of worried. That is a good thing. So those momentum names could do really well in July, maybe even in the rest of this year. Momentum's up 14% for the year. I don't think most people realize that. It's probably still going to lead, Frank.
All right. Really quick, Ryan, when you talk about momentum, and I'm not asking you to pick it, but you're talking about things like the ARK Innovation ETF. We hit this earlier in the show. Holds things like Tesla, Circle. Is that generally directionally when you're talking momentum?
Not so much. We like the momentum ETFs like MTUM, though the S&P 500 momentum ETF. So although Kathy's doing a pretty good job, and if you're hot, you're hot. So those are doing pretty good right now too. Wow,
that was pretty incredible. July just tends to overall be a very strong month, and to 3+% for the S&P in July is ridiculous. Now, some of his other stats are pretty wild as well. That would put the SPY in the 630s range. 3.5% upside would put the SPY in the 633-ish area. Yeah, I agree. Momentum is definitely the place to be. Now, I also want to share with you this clip from CNBC. It says a broadening of the market is beginning because I believe, actually, believe it or not, small caps are probably a good area to be in as well, specifically small caps in the AI sector, because that's where I think we're going to see hyper levels of growth, right? There's a lot of investments into AI names, and I think some of the small cap AI names are kind of underlooked right now. As we, start to focus more and more on 2026, a new Fed chair coming in and more interest rate cuts, I think this is really an area that can shine. Now, if you guys want to come, get access to all of the research that I am doing, the due diligence that I am doing and posting in the trading community, along with the stock picks that I am, making trades on and investing in. A lot of these are 6, 12, 18, 24-month time horizon trades, not day trades on some of these small cap AI names, some of these smaller cap biopharma names that have big catalysts right around the corner that are underlooked. Check that link out down below in the description of this video. That's what I am doing. That is the service that I am providing. I'm spending hours every day sifting through small caps, the bad ones, the good ones, all of them, to find the opportunities, to find the next 50 or 100x stock. That's the idea of the trading group. It's not about making 7% a year. It's about, yes, taking a little bit more risk, but taking a calculated risk, okay? If you do enough due diligence and sift through the good and the bad small caps, one small cap may have a lot of risk. Another small cap may be so underpriced that people would think it's risky, but maybe it's not as risky as it appears to be. So it's the balance between trying to find the next big stock or a big potential returning stock, while also saying, hey, this company is doing XYZ, it's trading at XYZ valuation, it's in XYZ field like AI, for an example, that all of a sudden lowers the risk profile of that stock. So there's a lot of criteria that these stocks that I am investing in and we are, investing in for the medium term have to meet to actually even qualify to go in the portfolio. And that also takes a lot of work as well. Check out the link down below in the description of this video if you would like to join. But let's take a listen to this clip on CNBC because I think it's very applicable to where we are at right now with markets that just hit new all-time highs.
A senior portfolio manager. No, we looked into the abyss when I think the S&P got down to, God, was it 4,800? I don't know where it was. We're almost all the way back to new highs. More new highs, or now we look around and say, okay, what do we do? We're back to where we started the year, basically. Up a little.
We're up just a little. So, from the abyss, we're up a lot, obviously. But, just for this year, we really haven't done very much, only up about 3.5% or so. So I think we can go higher from here. I think economic growth is okay. It's a little bit slower than it was. Rates are obviously too high. Having said all that, it feels like, from what we're hearing anyway, that businesses are on track. Some business that didn't close in the first quarter is beginning to close now, and it feels to us like the economy is doing okay. I think we're looking at heavy investments in AI, we're looking that's going to continue. but we're also seeing a little bit weakening of the labor market in here. So, I think there's a lot predicated on some of the decisions that get made. We're of the belief, obviously, that the Federal Reserve's rate level is too high right now, especially given where the labor market is. But if as we get these two cuts, this year, at least two cuts this year, I think as the residential investment is going to be critical for overall GDP growth, because really, if you're looking at CapEx spending in the U.S. today, it's really almost all driven by what's going on in AI and in technology. And residential investment has been tough. You're going to have down housing prices this year if rates continue this way. So we think the economy is on a good path, and we think the Fed should be a little bit more accommodative than it currently is. But the markets can definitely work higher as the economy continues to gain confidence. As I think continued deregulation happens now that we've sailed past the most difficult parts of tariffs.
Yep. Do you expect to see trouble ahead in the numbers based on the tariffs? I'm talking about the inflation side of things. And you said, yeah, the economy's doing well, so I think we could have some cuts. That doesn't make sense. You mean we could have some good cuts because there's no inflation?
Correct. There really is, and I think real rates, by holding real rates and having inflation continue to decline, de facto they're continuing to raise real rates, and they're continuing to run off the balance sheet. So, you're in this period where they're continuing to de facto tighten, which really doesn't make any sense. I think the inflation numbers are good. Look, there isn't a central bank, and these tariffs are a tax, right? So in 2018, the Trump administration's tax cuts came through, and the Federal Reserve was going to go well above neutral because tax cuts were inflationary. And now the tariffs, which are taxes on foreign goods, tax hikes are inflationary. None of it makes sense. This idea of waiting for this pass-through doesn't make sense either. You're either data dependent or you're not. Right now, where rates are would suggest you should cut. If there's massive pass-through and lingering inflation that goes on 6 months or a year from now, you can raise at a later date. Right now, this wait and see approach, given the labor markets, you've seen unemployment tick up 4 months in a row. It doesn't seem to make much sense. I'm not really. Their arguments are fairly weak here. I think arguments made by people like Waller more recently have been much more aligned with where I'm at in terms of you could probably cut sooner given the progress made on inflation and the lack of pass through thus far. Basically 0 to 525 basis points of Fed hikes in a very short period of time. And so we've had gains in the last few. So I think it's going to have to be earnings driven. We're looking next year for something like $300 of earnings power for the S&P 500, maybe $400 of cash flow. So 20 times earnings, 14, 15 times cash flow, not crazy expensive, but not certainly cheap. And so the leg that has to go on here are companies being able to meet or exceed those expectations and deliver on growth. So, I think if you look at the market overall, you'll find pockets of opportunities. And I think a broadening of the market is beginning. It was derailed in the first quarter, but it's beginning. And so, for us, I think that there's plenty of opportunity out there in the overall market. In general, the market's fairly valued, but there are certainly pockets of opportunity. Even in some of the bigger names, NVIDIA more recently has been going sideways actually got relative to its growth to a reasonable multiple. We also think the financials can continue here, both based on deregulation and then what we think is going to be a really interesting opportunity with the Genius Act and other legislation on stable coins and sort of new payment networks. Plus, I think a lot of the banks and a lot of the financials will be able to employ AI for a lot of the processes they have today and see tremendous cost savings. So there are certainly areas where we think there'll be margin improvement and earnings improvement over the next few years. And that's what we're trying to focus in on.
So yeah, I will say it is a bit refreshing to hear some bullish takes out there, some takes that are kind of in line with what we've talked about here on this channel, because a lot of people have been bearish on markets. And I guess that's what happens when you fall 20% and there's a lot of uncertainties out there that continue to linger. Now, tomorrow we do have very important economic data coming out. That is core PCE month over month. you're expecting 0.1%. I think there's a good chance we could actually come in at 0.0%. The last 2 months now have been at 0.1%. So getting a 0.1% number or even a 0.2% number if it comes in high is definitely not an issue at this point. Assuming it comes in at 0.1%, again, it's further validation the Fed should be cutting rates and that the Fed is really just delusional at this point, that they have lost competency. The Fed has effectively switched from a data-dependent approach to an opinions-based approach. And I mean, we can all see why now Trump is so frustrated with the Fed. At first it was like, okay, let's wait and see what happens with inflation. I can get behind that if we only had one good inflation report. Now, tomorrow morning, you're going to be approaching 3. Well, you're going to be at 3. And then it's like, dude, we should probably be cutting rates if we're 2.5%, above the inflation rate, right? If rates are 4.5%, PCE is at 2.5%, we should probably begin cutting rates. And the Fed, it's kind of delusional there. And that's why I think Wall Street's going to start focusing more on what the Fed composite is going to look like next year in 2026 with a new Fed chair that will be coming to the Fed. Now, we will also get personal income month over month tomorrow, expecting 0.3%. That would be a great number in line with closer to 2% inflation, and personal spending month over month is expected at 0.1%. So best case scenario, you want a low PCE report, a low personal income report, and a high personal spending number. That would be, the most ideal situation you could really have. But I think from my perspective here, again, I was calling for new all-time highs this week. It happened. And the odds are fantastic that we're going to get, more new all-time highs, that markets are going to continue to rally. And as the individuals in these clips have told us, July tends to be a really strong month for stocks. And I would not bet against that at this point. I also think a broadening is likely coming with more, interest rate sensitive stocks that likely start to do well, and maybe some smaller cap names. So let me know your thoughts on this down below in the comment section. Ladies and gentlemen, have a great rest of your day, and I will see you in the next one.